Okay, so we are starting in 3, 2, 1. Hi, everybody. This is Josh Jelinski, the financial quarterback, and we're being joined by exciting guest Tom Wheelwright, talking about his new book, The Win-Win Wealth Strategy, which is our free giveaway today. If you call us at 888-988-JOSH and request a free 45-minute wealth strategy blueprint. So the new book is called The Win-Win Wealth Strategy, 7 investments that the government will pay you to make. So Tom, for people who have not heard you on the show before, describe your background.
Yeah, just a little bit of it. I grew up in Salt Lake City, Utah. So as a good Mormon boy, I spent 2 years in France getting rejected in French. And then I spent a couple of years at the University of Utah for my undergraduate degree in accounting, and another couple of years at the University of Texas for my graduate degree in accounting and tax, and 7 years with Ernst & Young, including 3 years in their national tax office in Washington, D.C., 4 years as the in-house tax advisor for a Fortune 1000 company, 14 years as an adjunct professor in the Masters of Tax program at Arizona State University, 25 years buying, building, selling CPA firms, about 15 years traveling with Robert Kiyosaki around the world, teaching tax and financial education. And the last 5 years spent most of my time building a network of CPA firms around the country to teach people how to make way more money and pay way less tax. That's pretty much it, Josh.
So tell us about your new book, The Win-Win Wealth Strategy.
Yeah. So, Josh, and I know you're very familiar with my first book, Tax-Free Wealth. And Tax-Free Wealth was very much really to show you that the tax law is an instruction guide for reducing taxes. Win-Win Wealth Strategy really shows you how the tax law is an instruction guide for building wealth while reducing taxes. So there's a huge debate out there about, are the rich paying enough tax? Do they cheat on their taxes? Do they have these big loopholes? What's going on there? When I have to pay my taxes. And what I wanted to do with the Win-Win Wealth Strategy is just show you that there are 7 investments and really investment categories where anybody, rich, poor, middle class, can build wealth and pay a lot less tax as a result of building wealth and doing good for more people. So these are really 7 very, I don't think anybody would argue with any of these 7. It's just that we don't typically think about why is it that the rich or the wealthy don't pay as much tax? Are they really cheating, or do they just understand something that most people don't understand?
So your book talks about transforming the way people think about building wealth. Talk about that for us.
Yeah, well, first of all, remember that the single biggest expense you have is probably tax. And so to really build wealth, it's very hard to do so and pay a lot of tax. What most people think about tax is it's win-lose, right? It's either the government wins and I lose, or I win and by cheating and the government loses. And what the tax law, what's really fundamental about the tax law and has been for about 60 years is that there are certain types of investing that the government would prefer not to make itself. I mean, for example, the government, I don't think anybody says, boy, I wish I lived in government housing. And the government doesn't want to build housing. What they want to do is they want to encourage private investors to build housing and build affordable housing so that people have a nice place to live, and they give tax incentives to do that. So real estate is one of those areas, certainly one of the 7 investments that literally the government pays you to make that investment. But the real key here is that this is a win-win. So the government does win, but you also win. So, anybody who's ever gotten a paycheck quickly realizes by looking at their pay stub that the government's your partner, and you don't get to choose whether they're your partner. And you just get to choose how you're their partner. And so you can either be the silent partner or you can be an active partner. And the win-win wealth strategy just teaches you how to be an active partner, and where the government is always going to win, you can win at the same time.
No, that's exciting. So talk about this narrative of tax incentives are immoral loopholes. I know you mentioned that briefly. How can we change the narrative people have been fed on this topic? Because I think it's really one of these unhelpful things, but really the government wants us to spend money in this way.
Well, yeah, I mean, let me take one of the 7 that I talk about, which is agriculture, food production. I don't think there's anybody in the world who thinks that food production is a bad thing. I don't think there's anybody in the world who actually thinks that it's a bad thing that the government gives farmers incentives to produce food. And I don't think there's anybody who thinks that farmers are bad if they make money, right? So why are we saying, well, farmers are bad, but boy, Jeff Bezos, farmers are good, but boy, Jeff Bezos, because he makes money and, with technology, he's bad. And so, that's the mistake that's being made right now, is thinking that, wow, the fact that and I think a lot of them don't pay a lot of tax, because my clients don't pay a lot of tax. They're going, well, wait a minute, that's not fair. That's fundamentally unfair. Why do I pay tax and they don't? Well, what's unfair is that they can afford to have really good tax advisors and you can't. So what's unfair is that you don't have the education. So the win-win wealth strategy is an attempt actually to make the playing ground more fair. But the reality is that when you think about, take real estate or business, the reason government incentivizes business owners is because they want to create jobs. The reason they incentivize real estate, they want to create housing. They incentivize agriculture because they want to produce food. They incentivize energy because they want to produce energy. They incentivize technology so that we can produce more technology. I don't think anybody's complaining about having an iPhone. I don't think anybody's complaining about Amazon delivering to their door, the next day. I don't think anybody complained about that during the pandemic. And yet somehow we think, well, wait a minute, they did this, but boy, they make all this money. Why aren't they paying more tax? Well, the reality is they are paying a lot of tax. And you don't think, well, Jeff Bezos may not be paying a lot of tax, and Amazon, the company, may not be paying a lot of tax. All of Amazon's employees are paying a lot of tax. And so really the government's just saying, look, if you're going to employ a lot of people, we're not going to tax you directly. We're going to tax you indirectly by taxing your employees. Now, could would Amazon have to pay a lot less in salary if the employees didn't have to pay tax? Of course they would. So there's a lot of tax being paid here. It's just what people aren't understanding is, how is that tax being paid, and who's paying the tax, and what do you do if you want to participate in it? The reality is anybody can participate in it. You don't have to be rich to participate. You just have to learn the rules. You have to serve more people. You actually have to help more people. For example, if you buy a house for yourself, you get a small tax deduction. But if you buy housing for other people, you get a big tax deduction. So basically what the government's saying is, the more people you serve, the less tax you pay. And we don't think of it that way, because we don't often think, well, wait a minute, Jeff Bezos and Amazon serving a lot of people, but certainly I don't think anybody questioned, if you think about it, that Amazon serves millions and millions of people. Frankly, my book would not readily be available were it not for Amazon. And so, I'm actually very grateful for these companies that do this. Does it matter that the government gets their money a different way? I don't think so. And the reality is Amazon is currently paying tax, and they are going to continue to pay tax. Okay. And now that they've recovered all their losses, now that they don't have as many tax benefits from technology, because their technology is largely built, they did start paying taxes a few years ago, and they're going to continue to pay billions of dollars in taxes. So basically what the government's saying is, we'll be a partner with you in investing now, knowing that we're going to reap benefits in the future. It's no different than any other investor. If you're an investor in a real estate project, and you go to the developer and the developer says, look, I'll do all the work for you and you provide the money and I'll do all the work. Are you okay with that? Well, of course, because you're getting a nice return on that. Does it matter that the developer's getting a nice return on that? Of course not. You're both getting returns. So basically all the government's saying is, look, we're going to get a return and you're going to get a return. You're going to do all the work and you're going to get some of the return, and we're going to do none of the work, but we're going to provide some of the funding, and we're going to get paid back in taxes down the road. That's as a government, that's how we make money. And we're going to get paid back as you start producing a profit. And that's going on with Amazon now. It's going on with Tesla. They're starting to pay tax. So I think, the idea that they never pay tax is a fallacy. They may not pay tax early, when they're investing, but when they start making money, they do actually pay tax, and they actually pay a lot of tax.
Tell us about the research that you did when you compiled the 7 strategies for the book, The Win-Win Wealth Strategy.
Thank you for asking that, because we researched 15 different countries. So we have 150 endnotes for 15 different countries. We literally have 60 pages of endnotes. And the reason is because I wanted to show that this is not a US phenomenon. This is something that is common throughout the developed world. So, all countries have retirement plans. All countries have business tax incentives. All countries have real estate tax incentives. All countries have technology tax incentives, almost all. And, so what we did was we put together charts and tables to show, okay, here's the countries that do, and here's what kind, here's how they do it. And really all I wanted to show was that this is so common. This is so successful, and it's been so successful since the 1960s for the government to give a small incentive in order to get a big benefit, that it's spread throughout the world, and the whole world does this. This isn't like, okay, well, Jeff Bezos and a few others got together and say, well, we're gonna pressure the government to get these tax incentives. That's not at all what happened. What happened is that the government that got together and they said, and starting with John F. Kennedy, by the way, and then following Ronald Reagan, did a bunch of tax incentives and said, look, what happens if we give a tax incentive? Will people behave differently? And lo and behold, they do. None of us like to pay tax. So we will behave differently if we get a tax incentive. Anybody says, I don't like tax incentives, they're really being disingenuous, because you're getting tax incentive for your 401k. You're getting a tax incentive for sending a kid to college. You're getting a tax incentive for buying a house. Nobody is saying, I'm not going to take that tax benefit because, I would be evil if I did so. And yet somehow, if somebody who has a lot of money does a lot of good, and as a result gets a lot of tax benefits, somehow, they're bad. And that's a bad idea. But if I get tax benefits, it's a good idea. So I think we just need to have a better conversation about it. It's not a political book at all. It's just a book saying this is what happens and this is what happens throughout the world. We did the research and we've run numbers, and the numbers show that the government wins and the taxpayer wins.
And that's why it's called the Win-Win Wealth Strategy. You win, the government wins, your advisor wins, your tax person wins, and most importantly, society wins. There you go. I'm trying to find all the wins. So the Win-Win Wealth Strategy, 7 investments the government will pay you to make. We will take questions from the studio audience. So if you have a question, you're in Clubhouse, YouTube, type it in the chat box. We'll bring you up. You get to ask Tom Wheelwright, arguably one of the smartest CPAs in the world. Answer any tax question you have. And folks, for those of you who schedule your no obligation 7 ways to save on taxes review, we'll give you the book, The Win-Win Wealth Strategy, for free. Call us now, 888-988-JOSH, 888-988-5674. Again, the Win-Win Wealth Strategy book, available on Amazon for purchase, or you could call us now, 888-988-JOSH. We'll be back after these messages. And we're back with Tom Wheelwright. So let's go to the meat of this. Let's go into the 7 strategies. So I think, is it broadly business, technology, energy, real estate, insurance, agriculture, and retirement accounts? Are those broadly the 7?
There you go. Those are broadly the 7. You got it.
There we go. So how can we tax effectively invest in our businesses? Let's talk about that, number one.
Well, let's start with that. Business is the first one I cover, and the reason I cover it first and I cover it most in depth is that it's really the foundation for several of the others. The government throughout the world, governments incentivize business very, very heavily through tax laws. Starting by any money you put it back into your business, any money you earn in your business that you put back in your business, you're not taxed on. 100% of the money you earn in your business that you put back into your business to build your business, you're not taxed on that money. On top of that, you could start a business in your home. Now, I actually run these numbers in the book. You could start a business in your home, and literally the tax savings from starting that business could be greater than the cost of starting that business. So literally, the government will pay you to start a business. And I run through those numbers. The reason is very simple. It's that you have a lot of expenses that you're not deducting. So you're not getting any tax benefit for. And when you start a business in your home, you start getting to deduct those things, like your car, like your house, like your utilities, like your internet. I mean, you get to start deducting things you never were able to deduct before. So, I mean, most people know this because they know that if they were an employee for the last 2.5 years and worked from home, they got no tax benefit for doing that. But if they had a business and worked from home, they got to deduct their home office. So it's really been made obvious through the pandemic. And this book just kind of illustrates, just highlights that the government cares so much about people starting business that they literally will pay you to start your business. And you actually don't have to come out of pocket at all.
So what are some of those business expenses that you can write off if you're newly starting? You mentioned, I guess, energy, cell phone bill, internet bill. What are some other ones?
Yeah. So your car. Okay. A portion of the cost of your house, a portion of the maintenance of your house. Depending on what you do in your business, you might even be able to get some of your yard maintenance. Depending on what you do, you might get some of your storage. Okay. You might need to store product in your house, and you might have a place where you store it. You can be able to take deduction for that. Certainly any of the furniture or equipment that you use, you get a deduction for that. So you buy a computer for the business, you get to deduct the computer. You buy furniture for the business, you get to deduct the furniture. So it's pretty much, everything you buy for the business is deductible, plus a portion of your house, your home expenses, and a portion of your car expenses are also deductible when you have that business.
Fantastic. Next, let's go to technology. What are the tax breaks for technology?
Yeah, so this is a big reason why Tesla and Amazon, because they're the ones best known, have not paid a lot of tax. Is that not only do they get to deduct all the money they put in technology, but they also get a tax credit. Now, tax credit's different from a deduction. It's better because a tax credit is a dollar for dollar. So if you get $100 tax credit, you actually reduce your taxes by $100. If you get $100 tax deduction, you reduce your taxes by whatever your percentage is that you would owe on that $100. So if you're in a 30% tax bracket, you get $30. So a credit is always better than a deduction. And with research and development in the US, we give tax benefits by both allowing deduction and giving a credit. In some countries like Singapore, they give a super deduction up to 400% of the cost of the technology.
Wow.
In South Africa, it's 150% of the cost of technology gets deducted. So if you put $100 into your research and development, you get a deduction for $150. So that seems odd to us because we don't have deductions like that, but they do in a lot of countries. So research and development tax credits, research and development deductions, there are some countries like France historically has given a tax credit when you hire a PhD that's in your technology department. So, I mean, they're different in every country, and we do charts and tables for them. But in the U.S., it's largely the research and development tax credit and the research and development tax deduction.
So walk me through that. So somebody, I don't know, a business makes some money. They spend $100,000 on developing, I don't know, a new app or a new software or
Sure.
what would,
Or a new system.
or a new system. Would apps count or no?
Yeah, apps. They could count if they actually are in the nature of computer software. They would absolutely count. Not everything does. So you do have to have a team, a team of advisors that you work with. But let's say you do spend $100,000, then you get to deduct the $100,000, and on top of that, you get about a $7,000 tax credit. So you deduct and get a credit.
So what's the 7,000 credit? Is it just a flat dollar amount, or is it a
That's
percentage?
your research and development tax credit, and it's a percentage. Typically, it ends up about 7%. It's a credit against a credit that's a percentage of the money you spent on developing the technology.
And I'm sure
that includes, by the way, developing the technology includes salaries. It can include equipment. I mean, it does actually include all of the costs that go into that technology development.
And walk through, people maybe, think they're dumb, but it's an important distinction to make. What's the difference between a deduction and a credit? You talked about that a little bit, but
yeah. So again, a deduction is not as valuable as a credit. A credit is dollar for dollar. If you get a dollar credit, you get $1 in your pocket. A deduction just means you reduce the amount of taxable income, the amount of income you pay tax on. So if you got $100 deduction, you made $200, you got a $100 deduction. Instead of paying tax on $200, you'd pay tax on $100 because you get to deduct or subtract out that $100 deduction. And so, it depends on your tax rate. How beneficial a deduction is depends on how high your tax rate is. The higher your tax rate, the bigger the tax benefit to you. The lower the tax rate, the less the tax benefit, as opposed to a credit that whether you're in a low tax bracket or a high tax bracket, you get the same amount of money back.
Any other technology credits or deductions we need to be aware of?
There's a ton of very specific ones. Okay. So, and this is why, you go in and actually read the book, because there's a lot more I can put into a book than I can put into a show. And so we list out the requirements. We list out, okay, here's what's required in, to get that tax benefit, to get that credit and that deduction. And here's some of the different opportunities you have. So the most obvious one is the research and development tax credit. By the way, it's not just the federal credit. So like Arizona has a 20% credit. So on top of the 6% credit you get with the federal government, you get a 20% credit with Arizona. A lot of states have research and development tax credit. So don't forget that part of it.
Oh, fantastic. Next up, energy. What are the tax breaks about energy that we need to be aware of?
Energy's huge. So consider that it doesn't matter whether it's fossil fuel energy or if it's renewable energy. There are tax benefits for both. There have been tax benefits for fossil fuel energy back since the 70s. Okay, that was one of the early big tax benefits because there was such a need to produce and generate more oil and gas, and so the tax law basically allows you to deduct 100% of your investment. That's the biggest tax benefit for fossil fuel is if I put $100,000 into drilling an oil well, I get to deduct $100,000. So that means that if I earned $100,000 in my job and I took that 100,000 and put it into an oil well, I would not have to pay tax on the $100,000 that I earned from my job because I get an offsetting deduction by investing it into oil. Now, some people are going to say, well, I don't like that. I mean, I don't like that you get a tax benefit for oil. Well, I'm not telling you that I'm choosing that one's better than the other. I'm telling you, if you don't like investing in oil, don't invest in oil, invest in solar. Okay. So solar's even better, by the way, than fossil fuel. This year, if I put solar on my house, I get a 26% credit. So if I put $50,000 of solar panels on my house, I get a $13,000 reduction in my tax bill. Now, here's what's interesting. What's really fun, Josh, is when you combine several of these strategies, and that's when it gets fun. So if I have a business, so like I've got several businesses, and I run them out of a business, a building, an office building in Tempe, Arizona. And I'm putting solar on that building. And that solar will, because it reduces my energy costs, will basically save me about $7,000 a year. That's what we've calculated out. It's going to save me about $7,000 a year. The kicker is, so you go, well, that's a 7% return on investment. That's not bad. Yeah, but here's the kicker. I get a $26,000 tax credit and an $87,000 tax deduction. So I'm basically only paying about $35,000, which means that instead of a 7% return on investment, it's really more like a 20% return on investment, because I'm not paying for most of the cost. The government's paying for most of the cost. So this is where the government's paying for my investment, right? The government is paying me to invest in solar. And so I get the 7%, even though I only put in a third of the cost. Now, does the government get money out of that? Of course, because I would normally deduct the utilities that I pay against my rental income. I would deduct the utilities I pay, or against my business income. Well, now I'm not going to have those utilities. And so now I pay more tax on my business income, or I pay more tax on my rental income. So the government does get a return on that investment. And it's a pretty decent return. The taxpayer just gets a really good return because the government's putting in basically 2/3 of the cost, but they're only getting back, 40%, of the revenue, because, the highest tax rate's 40%. So it's actually a better deal for the taxpayer than, say, fossil fuel, where it's, the government puts in 40%, gets out 40%.
Now that's fantastic. What other energy credits are there, deductions?
There's all sorts of energy credits. Josh, you can get energy credits for putting in new windows in your house, right, that are energy efficient. There are energy credits. There are credits for biodiesel fuel. There are credits for hydrogen fuel. There are credits for wind, for hydroelectric energy. I mean, there's all sorts of tax benefits in there. You have to understand what they are. You sit down with your tax advisor. You say, okay, I'd really like to invest in renewable energy. Let's find out what's best for me. I mean, if you're in Arizona, solar makes all the sense in the world, and hydroelectric, not so much, right? But if you're in Seattle, Washington, hydroelectric or wind might make sense. Solar doesn't at all, because it's never sunny, right? So you really you get to choose which one you want to use. And that's the whole point of the book, is to give you some choices in how to invest and reduce your taxes.
Fantastic. And that's why you should get the book, folks, The Win-Win Wealth Strategy. You can get that on Amazon. Do you prefer people buy your book on Amazon or on your website?
You know what? The Amazon is great. We're happy to have them buy it on Amazon.
Okay, great. I always hated when my book was on Amazon, because you don't know. That'd be my tip. You don't ever know the data. Amazon doesn't share you the data, or at least if they bought on your website.
That's true. However, it does count towards bestseller lists, where buying on my website doesn't.
Oh, yeah. So hopefully this will be a bestseller, folks. It's the best book on accounting and tax in the last few years, at least since your last book. So it's called The Win-Win Wealth Strategy. Very tactical. 7 investments that the government will pay to make. Go to Amazon, buy it, or I'll give it to you for free if you call us for the 7 ways to save tax review. Call us 888-988-JOSH, 888-988-5674, 888-988-JOSH. And we're back with Tom Wheelwright talking about 7 strategies that the government actually will pay to make. So we talked about business, we talked about tech, we're talking about energy. Anything on energy before we go to our next tip?
No, let's keep going. Energy just is really one of the most interesting ones right now. I do remember that the tax credit goes down next year, and then after next year it goes away. So we do have to be on this right now.
The problem I have with the energy, this is just I find that that's a great tip, but like, who do you buy solar from? You always, there's different ways. Then people pay you, and then it's free solar, and then you lease.
You have to find, you know what? You've got to find a really good provider, and there are good ones out there. I mean, solar is a huge industry now. I spoke at their, I actually spoke at the solar industry conference up in Utah earlier this year, and it's a really, really big industry right now. And you do have to be careful. I mean, I'll tell you, I've got solar here at my house, and I had a battery go out. We're still waiting on a replacement. So you do have to. It's not just the company you buy it from, but who are their suppliers. We got supply chain interruptions. So, and you do need to get it put into place, because otherwise you're going to lose these credits.
Do you like one better than another, or not really? Just do your homework?
You know what? I like reputable companies. I like companies that have good service. And, the one I use here is a local company, and they're using Panasonic equipment. And, Panasonic's a good company. Panasonic builds for Tesla. So not bad.
Yeah. Next, we're going to go to real estate. So that's a big one. So let's, and that's, I guess, where you became first famous in the tax world on. So let's talk about real estate investing.
Yeah. So real estate's one of those, there's a lot of magic in real estate. I list out 8 tax benefits in the book. Let me go through just a few of them here. And remember, yes, there are tax benefits for buying real estate for yourself. There's, by the way, no tax benefit for renting your home, for being a renter. Renters don't get tax benefits, owners do. That's a very important distinction that people don't really always recognize. People will buy a house and say, I'm buying this house because I need the tax deduction. I'm going, well, don't buy a house because you need tax deduction. That doesn't make any sense. Buy a house because you want a house, and then take the tax deduction to offset some of the cost of the mortgage. But buying a house for somebody else is a lot better, because if you buy a house for yourself, you get a tax deduction for interest and maybe for some of the taxes. But if you buy a house that you rent out to somebody else, either on a long-term rental, say a monthly rental, or Airbnb, not only do you get those deductions, but you also get a deduction called depreciation, which is the wear and tear on the property. And that deduction right now is this year is as much as 20 to 30% upfront of the cost of the property. So you put $100,000, you go buy $100,000 house, which I know you can't do where you are, Josh, but you can do in the Midwest. You get say a $20,000 deduction the day you buy it.
Wow.
Now you need to go to number 2, which is the second biggest incentive, which is debt. Debt is highly incentivized by the government. In other words, they want you to borrow money. And the reason they want you to borrow money is because money is debt. That's money. Every time the bank lends money, every time the bank creates a mortgage, they put new money into the economy. They want that money into the economy to help the economy grow. So debt magnifies your tax deduction for real estate, called depreciation. And so let's take that same 100,000, and instead of buying $100,000 of property debt free, go borrow $400,000 from the bank and buy $500,000 of property Now, instead of a $20,000 deduction, you get to multiply that by 5 and take a $100,000 deduction. Again, just like fossil fuel, if you make $100,000 in your job and you turn around and put that into real estate along with the bank's $400,000, you don't have to pay tax on that $100,000 that you made at your job. So real estate, right now, this is the last year we get that that big deduction. Next year it goes down by 20%, and it's just a huge tax benefit when you combine it with debt. The third big tax benefit, Josh, is that you can sell real estate without paying tax, and there are very few assets you can sell without paying tax. Real estate and business are actually the two big ones that you can sell without paying tax, and so, when you consider I get a tax deduction when I buy it, okay, my tenants are paying off my debt, and I don't pay tax when I sell it. That's a pretty sweet deal. So basically, and you want to pay less and less tax, buy more and more real estate for other people to live in. I heard today a statistic, we're still short 1.8 million units of workforce housing. So we still have way more demand than we have supply, and inflation is running higher than debt for one of the few times in history. And when that happens, a hard asset like real estate can be really a terrific way to build wealth, help other people by providing housing, and do what the government wants you to do, and pay less tax.
Wow. So we're talking now to Tom Wheelwright, CPA, author of the Win-Win Wealth Strategy, which is our free giveaway. If you call us at 888-988-JOSH and schedule your 7 ways to save taxes review. The book is called The Win-Win Wealth Strategy, 7 investments the government will pay you to make. We talked about business, technology, energy. Now we're talking about real estate. What else do we need to know about real estate tax investing?
Well, first of all, most countries incentivize real estate. That's something that surprised me. I didn't realize when I started writing the book how many countries incentivized real estate, and that the incentives are actually pretty significant in all 15 of the countries we looked at. So it doesn't matter if you're in the U.S., if you're in Canada, if you're in the U.K., you're in France, Germany, doesn't matter. You're going to get some tax benefits. Again, you need to make sure that you don't do this on your own. You want to have a tax advisor, right? You want to make sure that you've got a team around you. Business, investing, they're team sports. So this is why, Josh, we're talking all the time, because you're financial quarterback. You're part of that team, right? So very important to have team members, whether it's tax advisors, financial planners on your team, and don't try doing this by yourself. But remember that anybody can do it. So you don't have to be investing $100,000. You can invest $10,000. There's no limit. There's no bottom limit on how much you can invest and get tax benefits. It's just really about the number of zeros. And so, people who are in a 30% tax bracket can also pay less tax. You don't have to be in a 40% bracket. You could be in a 20% bracket and pay less tax. We have people who are paying no tax. And they're not paying no tax legally just because they're doing a lot of good in the world. They're building a lot of housing. They're drilling a lot of oil, or they're doing a lot of solar. They're creating a lot of jobs. They're growing a lot of food. Whatever it is they're doing a lot of it, and so they end up paying very little tax.
Fantastic. So before we go to our next one, which is insurance, anything else on real estate?
Yeah, I would just know that, one last thing I would say is that, remember, in real estate, you also get all the business tax incentives. So real estate's a business. So you get the business incentives, you get real estate, and think about this, if you put solar on your real estate, you also get the energy incentives. So you can actually, real estate, you can combine 3 incentives plus add debt, and it can be a pretty, it's really a super investment.
Fantastic. Next, we're going to go to insurance. All of a sudden, I don't know if you noticed this, I'm watching your TikToks, and all of a sudden, insurance, I don't know, do you go on your TikTok, or do you have somebody else do that? Or a
That's,
little bit of
well, I'm
both?
the one who actually produces it, but I don't watch my
Well,
own stuff.
well, you're becoming famous on TikTok, but all over TikTok is you on tax saving strategies, but also insurance. Insurance has become popular all of a sudden. Infinite banking.
Yeah.
All these people are using basically boring old life insurance is now hot again. And you talk about that in your book. So talk about the tax saving strategies of of
I do.
insurance.
It's the first five I talk about really are all things that are business. They're kind of business type investments, including agriculture. That's a business, and they're really things that we do for other people. The last two are things we do for ourselves. They're insurance, or we do for our families. They're insurance and retirement planning. So insurance. The government in the U.S. has long favored the insurance industry. They really have. I don't know that there's ever been a case of whole life of a life insurance company going out of business and then the policies weren't automatically picked up by another insurance company. I mean, the government always makes sure that if an insurance company goes out of business, another insurance company takes over those policies. They don't want the insurance industry collapsing. What I learned several years ago, Josh, is that, we always think of two types of life insurance, right? There's term and there's whole life or universal life, which is permanent insurance. What I'd never realized until a few years ago, never really occurred to me, is that the real difference is that term insurance is an expense and whole life or universal life is an asset. And so the question is, do I want a small expense or do I want an asset? Now it's not a sexy asset. It's not going to make you, 20% returns. It'll make you, it's got that good, consistent, safe return, and it's an untaxable return. So, if it's making 4%, that's 4% non-taxable, which is equivalent to something more like 5 or 6% that would be taxable. So it's still a decent, it's a pretty decent return. You find, but what's better is that it's never taxed. So the life insurance, when it gets paid out, is not subject to income tax. And whole life, one of the benefits of that, of course, is that you can always 100% of the time use it as collateral for a loan. So if you, and debt's not taxable, right? Let's go back to the real estate chapter. Debt's not taxable. So if I borrow from the insurance company using my whole life insurance as collateral, I don't have to pay tax on that debt. Okay. And on top of that, if I use that money that I borrow to invest in real estate, I get the deduction for investing in real estate. I get to deduct my interest I pay to my insurance company, and my life insurance is still growing in value. So there's all sorts of things you can do with insurance. But most importantly is to realize that, to start out with, there's no tax on it when it's received by your heirs when you die. It's one of the few things that just is never taxed.
Yeah, it's really fantastic. And there are long-term care benefits, disability waiver of premium. One of the best things about whole life, even more so than universal, is especially if you get an athlete or somebody makes a lot of money and they're younger, they have something called waiver of premium in the event of disability. So we have some people, they put in, 700 grand a year in their life insurances. They get disabled. The insurance company is paying their premium.
Wow.
Your 401k doesn't do that. So
Right.
it's self-completing. If you get disabled or some type of, if you get paralyzed or you need an in-home nurse or you can't bathe yourself or dress yourself, or so many people worried about cancer, you can use that money and really get an advance on the death benefit while you're alive via what's called an accelerated benefit rider. It's really one of, like you said, it's a modest gain. Some people act like, I'm seeing these videos like you're making double-digit returns. No, you may make double digits in 1 year because the interest rate is higher or the cap is higher. But generally, like you said, 4% is probably the IRR on most policies, IRR meaning internal rate of return. But in a high tax state like California, New Jersey, New York, That's like equivalent to making almost 7% in a guaranteed vehicle. Where are you getting that? So
yeah, so I mean, you can compare it to a municipal bond. I mean, I would rather have the insurance because in a municipal bond, all I have is the bond, right? But in the insurance, I get the insurance on top of having the value, the cash surrender value.
exactly. We're going to go to some questions from the audience next, folks. So give us a call, 888-988-JOSH, if you want the free book. The book is called The Win-Win Wealth Strategy, 7 investments the government will pay you to make. You don't want to do this alone. So I'll have, if you want to talk to Tom's people, they do some great work at Wealth Ability with taxes. I know probably more about this stuff than any advisor that I know, financial advisor in the country. And I even had to hire Wealth Ability people because you can know a lot, but you really need a good team. You need a good financial advisor. You need a good tax professional. You need a good wealth strategist. You need a good tax strategist too. Sometimes, by the way, your CPA is good at doing taxes, but they're not good at strategizing. And that's what your people are good at, Tom. So folks, if you want that, we'll do a 2-for-1 special, 3-for-1. We'll give you the book, The Win-Win Wealth Strategy. We'll give you these 7 ways the government will pay you to make investments review. And I'll get Tom to have one of his people at Wealth Ability talk to you for a free consult, see if you're a good fit. Is that okay, Tom?
We'll do it.
I'll pull your arm, 888-988-JOSH. So, and I'm always learning when I'm hearing you. I have my questions later, but we'll go to the phone lines next. 888-988-JOSH, 888-988-JOSH. We'll be back. 888-988-5674. And we're back. This is Josh Jelinski, the financial quarterback. We're live on Clubhouse. You can drop your questions. We have put a link in to the book on Amazon, Win-Win Wealth Strategy, in the Clubhouse room. The power company will pay you or credit your account for excess solar energy produced. Mr. Wasaga, do you have a comment on that? Go ahead. Mountain? I don't know if I'm saying your name right.
I think she's gone.
Okay, she's gone. Okay. Do you have a comment on that, Tom? The government will pay you for excess credits.
On that. Typically, the power company will. It's not very much. You really, the goal with solar is to put enough on that you're going to use it all, because the retail price of electricity is like 4 or 5 times what the wholesale price is. So you're really not going to make a lot of money if you're selling it to the utility. But if you put enough on that you can use it all, that is, I got to tell you, when we put solar on, it reduced our utility bill in the summer by about 65%.
Wow.
And in Arizona, that's a big deal because our summer utility costs, under 15 here, they get really high. I mean, really, really high in the summer. And I've got, 5,500 square feet here. So we're talking about a lot of space to cool in the summer. And I got to tell you that solar has been, I had frankly, when I did it in part just because I like the idea of solar. I'm a big fan of green energy or renewable energy. I didn't realize just how good it would be by reducing my costs in the winter. We don't use as much, but we still use it all. So we don't really sell it back to the utility. That's you're just not going to make very much money on that, but you can make money by reducing your own utility costs.
Do you use like a power wall? I know Tesla is manufactured.
I have 2 batteries. I use 2 of them. I have 2 of them. So absolutely.
Do you use Tesla or Panasonics? Which one?
Mine are Panasonics. But what you want to be able to do is you want to be able to either heat or cool your house at night, right? So obviously no sun at nighttime. So otherwise you're relying on the utility for that. It'd be really nice because we produce excess. We produce excess electricity during the day. We have so much sun that we store it up and then we use it at night.
Wow. So folks, if you have a question, let us know. Just type your question in the chat box and I'll bring you up. We're talking about insurance now as a tax break. Any other comments on insurance? Do you like using... Oh, go ahead.
Just remember that if you're a business, you can deduct the cost of your property and casualty insurance, your directors and liability insurance. I mean, there's a lot of other insurances besides life insurance. My mother taught me when I was young, she says, the two most important people in your financial life are going to be your CPA and your insurance agent. So make sure you choose wisely. So I became the CPA, and I have a couple of great insurance agents because I do think that insurance agents can make your life a lot easier.
No, definitely. Big believer in that. So, yeah, and it's something overlooked. Even property and casualty, as 800 numbers have made them more commoditized. People have kind of forgotten the value of a good, even a car and home insurance person. Yeah. You get what you pay for with insurance.
No question. My insurance agent, I've had my insurance agent, same agent for 30 years. And I mean, if I have a problem, I just call him. I don't do anything else. I don't need to worry about anything. I just call my agent. He says, I'll take care of it.
No, that's fantastic. Any other comments on insurance? Some people will use like retirement plans to buy insurance. Do you like that?
I don't love it. You can. Retirement plans are a tax shelter, and insurance is a tax shelter. Now you're using a tax shelter for a tax shelter, and you end up paying more tax typically. So there are lots of exotic, insurance. It's so funny to me that insurance brokers are really creative. They are seriously some of the most creative people in the world. So, they'll bring you exotic stuff. If you don't understand it, take it to your CPA. If your CPA doesn't understand it, don't do it. Honestly, there's a lot of exotic stuff. There's some stuff right now that the IRS is pretty unhappy about in the insurance industry. So you do have to be a little careful, but plain vanilla stuff like whole life insurance, or universal life, that's pretty easy. It's a pretty, frankly, most people should, everybody should have some kind of insurance, but I would say most people probably should have some type of permanent insurance.
So you generally like life insurance that is funded with after-tax dollars like a Roth?
Yeah, or that's just funded out of my paycheck. I don't care. Okay. That doesn't matter. Because what I don't want is I don't want to fund it out of have it be in my retirement plan and then make the life insurance taxable. That's going to make the life insurance taxable. Remember, every dollar you take out of that retirement plan is taxable, no matter how you made the money.
Sure.
So why would I want to turn a non-taxable asset like life insurance into a taxable asset?
Yeah, that didn't make much sense to me, unless there was no other money, resources for it or something to the business owner.
Yeah, and the other thing is people go, well, if I take money out of my retirement plan, geez, I have to pay tax on it. Well, you got to pay tax on it anyway. It's just when you pay tax on it, right? The only difference is the 10% penalty. So, people make a big deal out of, well, I'm going to have to pay 50% tax. Well, no, you're going to have to pay the 40% no matter what. It's just the question is, are you going to pay the 10% penalty or not? Or, until you're going to wait till you're after 59.5, then you don't pay the 10% penalty. But I'm just not a big fan of, kind of using it for, like I said,
more than what it is.
Complicated ways. Yeah. Do what it's meant to do.
Fantastic. And folks, we'll take the final break of the hour. We're with Tom Wheelwright, the Win-Win Wealth Strategy, 7 investments the government will pay you to make. Next, we'll talk about agriculture and retirement accounts. So if you've been watching Yellowstone and you want to buy that farm, Tom's going to show me how to do it when we return. But folks, if you want this special book, The Win-Win Wealth Strategy, call us for the 7 investments the government will pay you to make review right now, 888-988-JOSH, 888-988-5674, 888-988-JOSH. And we're back with Tom Wheelwright. So Tom, tell me, I'm watching Yellowstone, watching Kevin Costner. Have you enjoyed that show or no?
I have not watched that show, but I am familiar with the show.
And so I want to buy a piece of farmland in Montana. Tell me how to do it.
Well, so here's the, remember that even the government recognizes that land doesn't wear out. So you're not going to get a deduction for the land itself. But everything you put into that farm, you're going to get to deduct every single dollar. And so that's why farmers rarely pay tax. Ranchers rarely pay tax. It's a pretty high risk business. I mean, you know that that's a very high risk business. There are some things you can do actually. Again, the more generous you are, the less tax you pay. So you can actually put, let's say you say, okay, I've got this ranch. I want to make sure it's never developed. I don't ever want, a housing project on it. You can do what's called a conservation easement. And even the IRS doesn't care. They're okay about this one. Okay. They're not okay about the syndicated conservation easements, but they're okay about this plain vanilla conservation easement, where what you're saying is we're going to put an easement, give it to a conservatory, a land conservatory, and never pay tax on it. And never develop it. And it never, ever can be developed. So you're going, I just like this ranch to be a ranch forever and ever. I had a client who did that. And the tax deduction was in the hundreds of thousands of dollars because it reduced the value of the property by so much. And, but he just wanted it to be a ranch. He didn't want it to be anything else. He just wanted it to be a ranch. And he actually wanted to make sure it was never developed. So he put that on there for charitable purposes. And then he got a tax deduction for it. But remember, all the money you put into it, like a business, but even more so. So like you put buildings on your ranch, those buildings are deductible. You don't have to, you don't have to depreciate those over 40 years. You can deduct those really fast. Any equipment you buy, it's going to be deductible. The cows you buy, deductible. So, the breeding costs, deductible, the seed, deductible, literally everything's deductible. And then if, assuming you make money, then the government gets their share when you make money.
Fantastic. So I can do it. Now, what about, isn't there some rule though about material participation or something? So,
well, the question is, are you going to be actively involved, or are you going to have somebody else do it? So if you have somebody else do it, that makes it passive.
So what about me? So what if I want to, so how many hours do I need to be involved in this?
Well, here's the thing. You really don't have to be involved in it. You just need a tax advisor that knows how to make sure that your passive losses are deductible. That's really the key. So, you can, if you're active in it, you're spending over 100 hours generally. If you're spending over 100 hours a year, then it may be that may free up the deduction for you. If you're not spending 100 hours a year, probably you're going to have to deduct it against other passive types of income. There are ways to create.
Now, is it 100 hours or 500? Why am I thinking 500 hours?
The really clear rule is 500 hours, but the reality is the real rule is 100. Okay. You'll have CPAs tell you what's 500 hours. The reality is that if you do 100 hours, you can probably get it to be deductible.
Oh, wow. So finally, we're going to conclude this excellent interview, the Win-Win Wealth Strategy, 7 investments the government will pay to make. Let's talk about retirement accounts. It's one of my favorite ones.
Well, let's talk about them. So,
because very few people even know all the stuff you can do with retirement accounts. So I love that your book touches on that.
Yeah. So it was interesting writing the chapter because I'm not a big fan of government sponsored retirement accounts, but it turns out that you actually can do pretty well with them. So if you're going to, depending on what you're investing, if you're investing in the stock market or you're investing in gold and silver, a retirement plan makes a whole lot of sense. a government sponsored retirement plan. That I want to distinguish there. So we have what we call qualified plans and non-qualified plan. A qualified plan is something where the government says, okay, we're going to give you a deduction going in. We're going to tell you what you can invest in, when you can take the money out, how much tax you pay, and and we'll tell you when you have to take the money out. Okay, that's a qualified plan. That's like an IRA, 401k, pension plan, SEP, profit sharing plan. Those are all qualified plans. Okay, they're specific in the Internal Revenue Code in the 400 sections of the Internal Revenue Code. Then you have the non-qualified plan, and in the Chapter 8, I talk about both of them. I talk about both the qualified and the non-qualified. The qualifieds do work. The average person probably should be maximizing their 401k because they don't want to get the education they need to do one of the other 7, right? But the other 7 could also be retirement plans. I mean, think about it. You can use life insurance as a retirement plan. You can use real estate as a retirement plan. You can use your business. Most business owners, their retirement plan is their business. It's not their 401k, it's their business. So you can use other investments as your retirement, and we call that a non-qualified plan. In a non-qualified plan, the government doesn't tell you how much you can put in. They don't restrict you. You can put all the money you want. They don't tell you what you can invest in. You can invest in anything you want. They don't tell you when you need to take the money out, or they do tell you how it's taxed, but a lot of times it's not taxed at all. So in a non-qualified plan, a lot of times you're never taxed on it. Whereas in a qualified plan, except a Roth, you're going to eventually be taxed on it. But remember, a Roth, you get no deduction going in. So I can have a non-qualified plan where I get a deduction going in and no tax coming out. And you cannot do that in a qualified plan. So while qualified plans work, okay, and they do make sense for the average investor, they do not work as well as a non-qualified plan if they're done by a professional investor. So, an average amateur investor who wants to invest in the stock market, little gold and silver, something like that, a qualified plan makes all the sense in the world. Somebody who wants to learn how to invest in one of these others, agriculture, real estate, business, etc., is going to do better in a non-qualified plan, and the returns are higher and the taxes are better.
Fantastic way to end the interview. The Win-Win Wealth Strategy, 7 investments the government will pay you to make. Want to thank you, Tom Wheelwright, for joining us. And there's a question from William before we wrap up. Go ahead, William. You're on with Josh Jelinski and the Win-Win Wealth Strategy author, Tom Wheelwright. Folks, if you want the book, call us at 888-988-JOSH to request the 7 Ways to Save Taxes review, or you can get the Win-Win Wealth Strategy on Amazon. Go ahead, William.
So I was just trying to figure out, how do I start a trust fund?
You mean an IRA trust fund or a trust in general?
A regular trust fund. You mean like for your kids?
Yes.
Okay, so trusts are amazing, and I haven't written that book yet. Okay, I probably should write a book just on trusts, because trusts are they're really simple. You meet with an attorney, you can set up a trust fund. For example, I'm setting up a trust fund right now for my grandkids, and it's really, really simple. It's not very expensive. You can have control over it. You can decide when they get the money, what they use it for, how they get the money. I mean, there's all sorts of things. On top of that, you can use a combination. Again, where you really get a lot of bang for your buck is when you use a combination of strategies. This is why you have a tax advisor and multiple people on your team. But for example, you can use a trust for your kids and actually have that money invested in real estate, or have that money invested in your business, or have that money invested. Actually, you can even have that money invested in life insurance on your life. So trusts are amazing tools. They're one of the many, many tools that we use in the tax advisory profession. And I would sit down, first of all, with your CPA, and then, of course, you're going to need an attorney to be able to set up that trust fund and make sure that you're doing something that makes sense, not just from a planning standpoint for your kids, your grandkids, but also a planning for you, so that you actually get tax benefits out of it, both income tax and estate planning benefits out of it.
Oh, fantastic question, William. And Tom, any parting thoughts for our listeners other than get the book, The Win-Win Wealth Strategy, today?
Yeah. So my final thought is to remember that the reason that the 7 investments work, and particularly the first 5, is that really the way it works is the more good you do in the world, the less tax you pay. The more wealth you build, the less tax you pay. The more income you make, the more tax you pay. But the more wealth you build and the more good you do, the less tax you pay. So you really literally can make way more money and pay way less tax.
Fantastic. And folks, get the book, The Win-Win Wealth Strategy, free when you schedule your own 7 Ways to Save Taxes review, 888-988-JOSH. Love the book, Tom, and always love to have you on the show. Tom Wheelwright,
Thanks,
The
Josh.
Win-Win Wealth Strategy. Thanks for joining us. I want to thank you all for joining us, Clubhouse audience, and thanks, Tom Wheelwright. Talk to you soon.
Thank you, Josh. Bye-bye.
Have a good one, John.
Bye, everybody.
Have a good night.